Are you correctly planning for and avoiding IRMAA? Now, Medicare's IRMAA is one of the most complex tax hurdles a retiree will face. And since nearly every retiree is on Medicare, it's one we all need to be considering. Now, in today's video, I'm going to shed some light on this complex tax hurdle and show you how you can better plan for this hurdle and thus save thousands per year potentially. Let's get into it. Now, for those that aren't familiar with what Medicare's IRMAA is, it's essentially a Part B and Part D premium increase that you will see if you show too much income. Now, we'll talk about what too much income is, but also understand that since 2010, the percentage of retirees that are subject to IRMAA has nearly doubled. And so this is a tax burden that an increasingly number of retirees are subject to. Now, IRMAA can be quite complex because it's a 2-year look back, meaning that the income you show at age 63 will affect the Medicare premiums you pay at age 65. Now, if you are subject to IRMAA, understand that it only lasts for 1 year and then the recalculation begins. And another confusing part of IRMAA is it's not based off your taxable income. It's based off something called your modified adjusted gross income. This means you're not able to take the standard deduction, and things like tax-exempt interest from muni bonds are added back in and counted against you. Now, on the screen, you'll see the updated IRMAA numbers for 2023. But again, here becomes the confusing part. Remember that IRMAA is a 2-year look back. And so what you'll see are the 2023 numbers are based on 2021 income. And so as we sit here in 2022, as you're performing things like Roth conversions or deciding where to take income from to try to avoid something like IRMAA, we don't know what the 2024 IRMAA tables look like yet. Now, as a retiree, this seems absolutely ridiculous. So the government is going to subject us to an added cost, but they're not going to tell us where these zones for these added costs fall. So we really can't plan that adequately around that, can we? Well, in today's video, I'm going to show you exactly how IRMAA is calculated so we can start to make estimates moving forward in the future and thus start planning in 2022 for IRMAA that we might have in 2024. Now, before going into this IRMAA calculation, I want to show why it's so important that we accurately estimate IRMAA. One of the most frustrating aspects of IRMAA is that it's a tax cliff. This means that as a single filer, if the first IRMAA threshold is $97,000 of income, and you show $97,001 worth of income, you'll be subject to the full IRMAA expense. So despite only going $1 over that threshold, you fell off this tax cliff, which means that the importance of nailing down IRMAA is amplified because of this. Now, as we're planning for IRMAA, we essentially want to be in scenario 1 or scenario 2. Now, this diagram on the screen shows in gray modified adjusted gross income on a scale, and then the red lines are meant to signify the IRMAA threshold zones. And so we want to be in scenario 1 or scenario 3. Scenario 1, we're avoiding IRMAA altogether. We're bringing our income up as close through IRMAA as possible. In scenario 3, we're pushing through IRMAA and we're bringing our income up as close as possible to the next IRMAA zone. And so we know that we'll pass that IRMAA threshold, we'll have that added expense, but now we're taking that added expense and we're spreading it out over an increased amount of income. You want to avoid scenario 2 here. The reason being is you can see that this person's modified adjusted gross income was taking $1,000 more than the first IRMAA threshold zone. We see at the top of the screen that the first IRMAA threshold zone expense is about $937.20 per person. And so let's say this was a single filer. They show $1,000 over this IRMAA zone. Let's say they're in the 22% bracket. That $1,000 is going to be taxed at 22%. They're going to owe $220 in income tax, but then they're also going to have a $937.20 Medicare expense. And so by going $1,000 over this zone, this person ends up paying more in taxes and expenses than they took for that extra $1,000 worth of income. Now, if you're looking at this diagram and seeing that this is a tax cliff and saying, hey, I should just be a lot more conservative with planning relative to IRMAA, that can also be a pretty big mistake. And here's why. Let's take an example of someone in 2021, and they are Roth converting through the first IRMAA zone, but they're stopping before the second. Well, here's the problem if you're not planning for IRMAA for 2 years in advance. Remember, IRMAA is a 2-year look back. So let's say this person mistakenly used the 2021 numbers. Remember, if you're looking at the 2021 numbers, that's based off 2019 income. And so if you're using 2021 numbers in 2021, you're using the wrong numbers. And so this single filer would see that if they're going through the first IRMAA zone, it starts at $88,000 of modified adjusted gross income, and they can take their income all the way up to $111,000. So the first IRMAA zone has $23,000 worth of room, and the first IRMAA expense is $937.20. And so this person brings their income up to $111,000, and they calculated out that, okay, for the extra $23,000 of conversion room, I'm paying about $940. That basically translates to a 4% expected marginal tax add-on from adding on that IRMAA expense. But here's the mistake this retiree made. Again, when they were planning with 2021 numbers, they should have been planning for or estimating out 2023 numbers. Well, now we know what the 2023 numbers are. Now with these numbers, we see a retiree can bring their income up to $97,000 worth of income and not yet be subject to IRMAA. And if they were moving through the first zone, they could bring their income up all the way to $123,000 worth of income. And so when this retiree brought their income up to $111,000, they missed out on an extra $12,000 worth of room they had within that IRMAA bracket. And so because of this, their actual marginal tax hike was almost 6.7%, much higher than the 4% they were planning on before. And now it might not have made as much sense to bring their income that high and thus go through that IRMAA zone. And so adequately planning for IRMAA and estimating it in the future is extremely important to making the best tax decisions for your situation. Well, now that we understand the importance of planning for IRMAA, let's talk about how IRMAA is determined from year to year, and then we can start to apply that into planning and estimating future IRMAA brackets. So this is a little bit of a complex calculation. I recommend after going through this explanation, pausing the video, walking through the steps yourself, and thus calculating it out and gaining an extra level of understanding that way. This is something that either you or your advisor should be doing for you on a regular basis as we try to avoid IRMAA. So we're gonna walk through showing how 2023 IRMAA was calculated out. So first off, because IRMAA is indexed for inflation, we need to obtain the monthly CPI-U data. You can obtain this from the Bureau of Labor Statistics or the St. Louis Federal Reserve. Now, an important concept that we're going to need to understand when we're calculating out IRMAA is that IRMAA from 2011 to 2019 was not indexed for inflation. In 2020, it resumed being indexed for inflation. And so 2019 is your base year. This is going to be the base year continuing moving forward in the future, and is one we're going to peg all calculations off of. So in step number 2, we're going to want to average the 12-month CPI-U data from the base year starting in September 2017 to August of 2018. We're always going to use this September to August timeframe in order to calculate inflation adjustments moving forward. And the reason we're using 2017 to 2018 is because the base year is 2019. And so the 2-year look back would then be from 2017 to 2018. Now, as you average these out, what you'll find for that base year is the average is $249.28. Now, then what we're going to want to do is we're going to want to take the average 12-month CPI-U data from September 2021 to August 2022. This is going to be the time frame that determines the inflation adjustment here for 2023 IRMAA. And so what we would find if we average this CPI data, we'd find an average index value of $285.84. So in step 4, what we're going to want to do is take the values from steps 2 and 3 and find the percentage change. And what we would find is that from the base year to the most recent period, it's a 14.66% increase. So now remember here that in 2020, IRMAA started re-indexing for inflation. And so the year before it started re-indexing is your base year that you're going to apply this percentage change to. So 2019 single filer brackets is what we're going to want to use here on a rolling basis. And so what we'll do is we'll adjust the base single filer IRMAA zones by the value found in step 4 and then round to the nearest 1,000. Okay, so I have the calculation here on the right. If we take the 2019 first IRMAA zone, that's 85,000. And now we are going to multiply this by the 14.66% increase. And what we'd find is a value of 97,461. Now remember, we wanted to round to the nearest 1,000. And so in this situation, we'd be rounding down. And so what we'd find is the 2023 first IRMAA zone is 97,000. And so we see that our math checks out properly. And so now what we'll do is we'll go through each single filer IRMAA threshold and we'll apply that same 14.66% increase. And then for the married filing brackets, what we'll do is we'll double each of those single filer zones. Now, if you're completely confused right now, this is understandable. This is a complex calculation to make. Again, I recommend pausing the video, walking through the steps yourself, and then seeing if you come with these same numbers. If not, you might need to reread the explanation and then recalculate out those IRMAA thresholds. If you have questions, leave them in the comments below. Now let's pause here for a second, because although we just calculated out the 2023 IRMAA brackets, that really doesn't help us sitting here in 2022. Because again, we care about the 2024 IRMAA brackets, which we don't yet know. And in fact, we won't know until August of next year, because remember, the calculation is from September to August. At the time of recording this video, we only have 2 of the 12 data points we need in order to calculate out the 2024 IRMAA zones. And if we wait until the end of the year, we're only going to gain another data point. But nonetheless, the 2 data points we have are extremely helpful. And so what we can do to start to calculate out the 2024 IRMAA brackets is upload a inflation estimate. I recommend being a little bit more conservative on that inflation estimate, and then we can start to see how these brackets change through time. And so don't use a 10% inflation estimate moving forward in the future, because you likely will overestimate where these IRMAA zones fall and likely fall off the tax cliff. And so be a little bit more conservative when we're planning for the future, at least on the adjustments in these IRMAA brackets. But let's walk through 2 different estimates for where we think the 2024 IRMAA brackets may be. First, we're going to look at 0% inflation from now until August of 2023. If that was the case, remember, we already have 2 data points. We've seen inflation through those 2 data points, and so we can already make those adjustments. What we would see is the first IRMAA zone for a single filer would rise to $102,000, and we double that then for a married filer. This is the easy and certainly more conservative calculation. Because we've seen inflation relatively high though, what happens if we use a 5% inflation estimate? So if this was the case, you would see a slightly higher adjustment. Rather than being at $102,000 as that first IRMAA zone, you'd see it at $104,000. And so depending on how aggressive you want to go with these inflation estimates, that will obviously affect your estimate for IRMAA down the line. Now, due to these complexities and also the penalty for miscalculating that tax cliff that we discussed earlier, this is why this is one of the most confusing tax hurdles for retirees. But nonetheless, although we don't create the rules for the game, we have to abide by them. This is clearly a system that only a true bureaucrat could have concocted. But nonetheless, this is a process that we need to go through each and every year in order to make the best tax efficient decisions for our retirement. Now, using this video will help you adequately plan for these Medicare decisions moving forward in the future. But also understand that you also have some get out of jail free cards if your situation applies. I talk about this get out of jail free card in this video right here, where we talk about the ability to appeal a Medicare decision and thus reverse IRMAA altogether. Click on this video to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching.